Welcome to the AmCham channel. I am Anthony Galliano, the president of the American Chamber of Commerce in Cambodia. AmCham is launching the AmCham channel for three purposes. One, to keep the market abreast of updates, practices, regulations, things that affect business that are important topics, and we will be bringing experts in to discuss it. Two, to give you advocacy committee updates. We have 7 advocacy committees. We will be updating you via video and other means, so you know what we're doing in terms of our advocacy committee. 3, we'll be showcasing members. We'll showcase their products, their services. They could tell us about their business and their plan. And 4, finally, we will be giving you some footage of some of the events that we have, which seem to be very popular and well attended. And we'll be happy to show you what goes on in these events. Today, we're going to talk to Kieran Gaffney, who is the Regional Transfer Pricing Director for VDB Lloyd. VDB Lloyd is a gold member of the American Chamber of Commerce in Cambodia. Tax is a very, very popular subject among businesses, probably one of the most popular topics. Transfer pricing is a very complicated matter. So I think I'm very happy to have you as an expert, Kieran, to come here and tell us about transfer pricing today. Can you give us a little bit about your background?
Yes, I am a UK trained tax advisor. So I completed my ACCA in the UK, my Association of Taxation Technician exams in the UK. I worked for a firm called Smith & Williamson in the UK before moving to Ernst & Young in the Middle East. I worked there for close to 3 years, and I've now been in Cambodia for 4 years, firstly with KPMG, and now in my position with VDB Lloyd.
Well, thank you for joining us today. So there's a famous practice number 986 MEF, which was introduced on the 10th of October 2017, which really launched transfer pricing in Cambodia. So in a very simple form, what is transfer pricing?
Transfer pricing is effectively a mechanism that the tax office uses to ensure that related party companies, both domestically and internationally, so any company transacting with a Cambodian taxpayer is doing so at the market value rate. So effectively, it's to ensure that related parties don't manipulate prices to reduce profit, for example, in one jurisdiction, and potentially increase profit in another jurisdiction which has a lower tax rate. So from a global perspective, it would lower their tax burden, but one country is losing out and not getting their fair tax stake. So in Cambodia, as you mentioned, PRACAS number 986 is the regulations or the guidelines here upon which Cambodian taxpayers need to comply and also use to ensure that they have tax auditable defense.
So in the simplest form, if you're a Cambodian taxpayer and you're doing business with a related party, and we'll get into a discussion what that is, a related party, you need to apply transfer pricing policy in your taxes.
Correct. Yeah, you basically need to be able to prove that that transaction that you're undertaking is being undertaken at market value. Now, what does that mean? That effectively means as though it was being undertaken by 2 independent parties operating on the open free market. So you're effectively charging the price or being charged the price that you would be if you were transacting with an independent party.
And this is what's called arm's length basis.
Correct. That's the arm's length range or arm's length principle. Yeah.
Right. What is a related party? So that's clear when you're applying this as a taxpayer and it says related party. What does that mean?
So this can vary by jurisdiction, but in the context of Cambodia, what it means is any company where there is common control. Now, by common control, that means a 20% shareholding or board voting rights. So in simple terms, any company which owns 20% of your company, any company which you own 20% or more of as well, and also brother and sister companies. So companies which are under the common control of one of your shareholders. To expand on that a little bit as well, it also has family relationships. So if a husband owns one company and is transacting with a company which has a 20% shareholding or board voting right of his wife, then they also are a related party.
Okay. And I guess there is sometimes confusion out there with Cambodian taxpayers as what types of transactions would be affected by this. Because it is still kind of new in Cambodia, although it was introduced in 2017. Really, I think on audits, you're seeing a lot of application
Absolutely.
of transfer pricing. So what types of transactions should taxpayers look out for or businesses look out for?
Yeah, I would say there's four common type of transactions here. One is purchases from related parties, so purchases of materials. We're in a country where there's a huge garment manufacturing industry, so the materials that are purchased to be manufactured. Then on the opposite side, sales to related parties. So if you have an electronic device which has been made here, that sale onto a related party is also a very common transaction type. Then there's two other transaction types. One is loans, both interest-free and interest-bearing. Inbound loans are very common here in Cambodia because it's the way to fund operations, particularly during the first 3 to 5 years when companies may be loss-making for a period or are particularly capital-intensive, so need that startup funding. And the final one is intergroup services. So you'll often have an ultimate headquarters or a regional headquarters which provides services to a Cambodian taxpayer and as such charges for those services.
Okay. I guess one of the reasons why you see a lot of loans is because the capital requirement here is quite low.
Yeah, so in other jurisdictions you would have a debt to equity ratio as well in the tax law, which in general it does not apply here. It does in the energy and mining sector, I believe, but nowhere else.
Okay. There are methods that the tax department the GDT has come up with. I believe there's 5 methods. Now, without going into too much detail what those 5 methods are, in terms of how they apply, what are the 5 methods that are approved by the GDT?
Okay, so I'll speak about the one which is most commonly used, which is the transactional net margin method. This is used to effectively measure a company's operating margin on a whole of entity basis. So you're looking at the operating margin or net cost plus of a Cambodian taxpayer and comparing it to other similar type companies around the region to basically say on a whole of entity basis, this company would seem in compliance with the arm's length principle. There's also a method called the resale price method. Now this is generally used for distribution companies. So for tobacco, alcohol distribution companies in Cambodia, you'll quite often use the resale price method. However, there is issues with data. Some data for the resale price method is difficult to come by. Thus, even those companies often have to use the transactional net margin method. The cost plus method, which I believe is a method people will be commonly used to in business because quite often you use the cost and you add a margin when you're selling any particular item. So the cost plus method isn't used commonly in Cambodia for one reason, and that's because the accounting standards by jurisdictions vary. So what is direct cost of goods sold in one jurisdiction and what is admin expenses in that jurisdiction could vary versus another jurisdiction. So the data is often viewed as unreliable by the tax office. Then you have the internal and external comparable uncontrolled price method.
It's a mouthful.
Yes, more commonly known as the cut method. And that's when you'd really be comparing a single transaction versus another single transaction. So a good example of this would be loans. You would look at a loan which has been operated under similar type conditions. You'd compare the interest rates among, maybe 4, 5, 6, 7 different loans to the interest rate that you are applying to see whether you are actually within the arm's length range. And the least common is the profit split method, which is effectively a method where you might split the profits based on capital contributions. I've never actually used that method in Cambodia. I'd be surprised if it ever has been used in Cambodia. So you're probably most likely going to see transactional net margin method and the cut methods being the ones which you use here in Cambodia.
Yeah, I'd like to talk a little bit about shareholder loans and being at a 0 interest rate or a low interest rate. I think the market rates in Cambodia generally for borrowing from banks are about 8 to 9%. That's sort of a rate that's usually applied in audits.
Yes.
So there was another instruction release beyond the MEF's Practice 986. And this happened the following year in August of 2018.
There was an update in August 2018 which basically told us that interest-free loans were no longer automatically allowable. That's correct, yes.
Right. So this, I think, could be a little bit difficult to digest because you have the transfer pricing practice in 2017, and then you have the instruction in August of 2018. And I think on audits, the taxpayer would defend that that really started applying in August 2018 rather than earlier in 2017. What is, in your view, would be when interest-free loans really fell into transfer pricing?
The tax authority will argue that it was from 1 January 2018. They have communicated they believe that to have been the case. However, for me, I find that to be relatively unfair to taxpayers because there was this grey area in the law where we didn't really understand how the transfer pricing regulations, so PRACAS 986, corresponded with the regulations which allowed interest-free loans to be automatically allowable in Cambodia. And it wasn't until August 2018 that taxpayers really got clarity on that. So in some circumstances, I have been able to defend that a taxpayer's interest-free loan, should be allowable up until that date in August, and then afterwards, interest should be deemed and accrued. However, the tax office's starting position is that it should apply from 1 January 2018.
I think for my experience, interest-free shareholder loans are one of the most targeted transactions in terms of audits these days. So really, if we could just spend another minute on what would a taxpayer have to do to, one, let's say, prove a zero rate, or two, a lower rate?
Yeah, so a moment ago you mentioned the domestic interest rates here at 8 to 9%. And 2 or 3 years ago, that would be the starting position of the GDT. I've actually seen them move to nearer 6 to 6.5% recently. And I believe that's a development in their understanding. And by that, I mean the credit rating for Cambodia dictates that an inbound loan should actually be 6 to 6.5%. Now, from a smaller interest-bearing loan, how would you go about justifying that as a starting point? The way I do it is generally prove that this loan wouldn't happen to this Cambodian taxpayer without their overseas head office guarantor. Thus, the actual interest rate should be the one that the overseas guarantor would pay. So this is quite often in Singapore, and you can then generally build an argument to say that the interest rate should be 2.5% to 3% rather than 6 to 6.5%. Now, the other part of your question, which was specifically around interest-free loans, you really have to prove, and taxpayers don't really like to do this, that the loan isn't really debt. It's actually more equity-like in nature. Now, the arguments I've put together around this before are around the term length. So if it's kind of 10 years plus, it's around whether it's secured or unsecured. If it's unsecured, then you can tend to argue that, they aren't necessarily looking for a repayment here because they haven't secured their loan against anything. And, the third one is hand in hand with that, which is basically to show that there's no real expectation of repayment. Repayment might happen in 15 years when the company is profitable and can make repayment, or it may never happen. It may just have been the way that they look to fund because debt is more flexible than equity when you're trying to withdraw it.
I think I'll touch on one last transaction, which is services provided by a related party, not rather buy and sell. I think that's pretty obvious. If you're selling to a related party, it should be at arm's length, or you're purchasing from a related party, it should be at arm's length. But there are services at times performed by a related party, whether it's a parent that has a centralized processing, let's say, of certain things. It could be financial reporting, it could be accounting, it could be management services to help an allocation, let's say, to the subsidiary for management, providing oversight, it could be a number of things.
Yeah.
So, what those types of transactions also are quite under heavy scrutiny and audits. What's your recommendation there?
The first thing Cambodian taxpayers really should be looking at is, do we have a legitimate cost base? Because if you don't have a legitimate cost base, the GDT can quite rightly turn around to you and say, there's no real cost here. So why are we going to allow this fictitious amount where you can't prove that an actual cost has been incurred? That's a burden of the taxpayer. And I mention that because when I look at a lot of intra-group service agreements, they're tied to a percentage of revenue or net profit or fixed assets. And by doing that, you're immediately raising a red flag to the General Department of Taxation, because in their minds, you aren't establishing a cost base first. You're effectively saying, whatever this amount is, you are going to have to pay X percentage of it, even if the cost is, far lower, or it could be far greater. So the first thing I would advise Cambodian taxpayers is communicate with your regional headquarters. Make sure you have a direct or indirect cost base. A direct cost base would be being able to prove that, a certain person's salary, or that person in Singapore, for example, is just dedicated to providing services for Cambodia. Indirect cost model might be that, like you said, there's a regional service center which supplies services to 15 different companies in the region, and basically they apportion that cost based on revenue or net profit, whatever it might be. So they attribute value that way. But the starting point really needs to be establishing that cost base. That's what I find Cambodian taxpayers are still getting so wrong.
I guess one of the questions that may be on a lot of people's minds, why transfer pricing? What are the sort of flagrant violations that in accounting and I guess cost apportionment, why transfer pricing is necessary?
So in the context of Cambodia, the government wants to make sure that they're getting their fair tax take. So one of the easiest ways to manipulate profits to a more favorable tax jurisdiction, which is maybe 10% corporate income tax or 0%, would be to manipulate the prices charged between related parties. So, for example, on an interest-bearing loan, you could be charging, 15%, even though it's not justifiable. On, management and technical services, you could be charging any amount and almost justifying it.
I guess one of the reasons also is that you could be producing something here, and let's say selling it to at a very slight margin to another jurisdiction, let's say Singapore, which has a very good in terms of tax regime, not tax regime, let's get the tax rates, and then Singapore sells it at a higher profit, and by selling it at a higher profit, they pay less taxes, but Cambodia doesn't get their share here because the margins are thin.
So it's effectively what you just alluded to. It's making sure that Cambodia gets the right tax take for the value being added by that company in Cambodia.
Okay, I guess so. To close up, what is required by the GDT, and what recommendations do you have to taxpayers?
So my key recommendation is, if you have large amounts, so whatever that may be percentage-wise in your business, if a large percentage of your transactions are related party transactions, make sure that you have formal transfer pricing documentation as required by the law. Make sure that documentation has substance to it. That substance tends to come in the form of a financial analysis, which is usually in the form of benchmarking. In addition...
Which is something you do.
Yes, yeah.
And it's quite lengthy.
Yeah, you will have seen one or two of the reports I've put together in the past. The benchmarking process can be quite extensive. You're often starting off with a database of 70,000 plus companies and whittling it down to, the 8 to 12 most comparable companies to the one that you're looking at here in Cambodia, with various quantitative and qualitative screens. So having that documentation with benchmarking is a great starting position. You then should have other supporting documentation. For example, with a loan, make sure you have a loan agreement. Make sure you have a business plan justifying what that loan is being used for. Have a board resolution showing that, it is a loan and it's not actually a capital contribution. for management and technical services have backing to show that there is a cost base. So depending on the type of transaction, you really need to have both the transfer pricing documentation, but also supporting documentation to go along with that.
And the GDT requirement in case of an audit, are those things anything additional?
In general, they will look at the transfer pricing documentation as a starting point, or they'll look at finding out that you don't have one and rub their hands together because they think this is going to be easy. And then, yeah, depending on the transaction type, like, purchases and sales, you're looking at invoices, purchase orders, as I said, for management and technical services, really backing around, demonstrating that there's cost. And those are the main things which will be the starting point of what the GDT asks for.
And these transactions annually have to be reported on the annual tax on income.
And this is a question I get asked a lot. Should we say, yes, we have transfer pricing documentation? Should we have no? Should we say no? Should we leave it blank? My advice is, if you do have legitimate transfer pricing documentation, of course, tick yes. If you don't have it, I would suggest either ticking no or leaving it blank. Because saying you have something which you then will be asked for later and you don't have it immediately makes you seem like you're a taxpayer acting in bad faith. And that's not a position you want to be in. So either say yes, no, or leave it blank, dependent on your circumstances.
Well, I want to thank Kieran for doing our first AmCham channel video and covering a very complex topic. You could be reached at VDB Lloyd.
That's correct. So I'm based here in Cambodia, even though I have regional commitments as well. And we have a core transfer pricing team who can help with full suite of transfer pricing matters from compliance, advisory to audit.
And let's not underestimate just how complex it is. I've seen one of your reports in 68 pages, which is being handed over to the tax department for them to review. So it's quite a bit of work to do, and you do a great job.
Thank you.
Well, thank you. We look forward to our next video on the AmCham channel. Have a good day.